Online for beginners, what you need to know before you invest. Today, we're going to talk about bonds. And we have one of the best asset managers in Switzerland who is an expert in bonds. He is a recognized bond specialist. His name is Helge Müller. He's the owner and CEO of Geneva Invest, and today he will tell us everything important about bonds. Caputo and partners, we truly always fight for your money. Helge, could you please explain what exactly a bond is and how it fundamentally works?
It's quite simple to understand. Essentially, a bond is a formal loan agreement established between the issuer, which is the entity that issues the bond, and the investor, who is the individual or institution that purchases the bond. Typically, these are either governments, municipalities, or companies that issue new bonds. And the company or the government needs the money to carry out projects. For example, right now, the German federal government, which is massively increasing its debt. When they do that, where do they get the money from? They issue new bonds.
So the whole project with the military that Europe is now discussing, they want a European army. If that goes through, it will be financed by bonds. Is that correct?
It's financed exclusively through bonds. They issue bonds and someone has to buy them, namely an investor who thereby enters into a loan agreement. And the Federal Republic of Germany provides a guarantee for two things. First, a fixed interest payment every year. And second, the repayment of the principal at the end of the term. That is the guarantee that the company or the government provides. Of course, a guarantee is only as good as the guarantor who provides it.
Exactly. Because earlier you explicitly told me that for your clients, you never typically buy government bonds, but rather you exclusively focus on corporate bonds.
Yes, that's absolutely right. Because the essential point is this. If I possess a financial bond and the issuer unfortunately doesn't pay, then of course I certainly want to get my money back and apply significant pressure on the issuer. But it's quite difficult to get your money from the German government.
Put pressure on them.
Of course, the German government is also a good issuer with a AAA rating, but in principle, we have a certain mistrust. We prefer companies. There I have a big advantage, namely, if the money isn't paid on time end, that's regulated differently in every country, but usually it's 30 days here in Central Europe. In Northern Europe, it's just 1 day then. The bondholders can go and say, hand over the keys. I now own the company. The shareholders are expropriated. As a bondholder, I then own the entire company.
You have the privilege. So you have a priority over the shareholders. So bondholders have priority over shareholders. First, the shareholders are on the hook. They have to pay first. And only then do the bondholders, the investors in bonds, come into play. They only come after that. So first, the shareholders have to lose their money. And only then the bondholders. That's why it's also much safer than stocks.
Yes, of course. And the advantage of bonds, of course, is that I can look into the future. It's the only asset class, at least that I know of, where I actually know the future. Because the point is, if the issuer pays the interest and the principal back, then I know exactly how much I will get. That means based on the price, the issue price of the bond, or the current price, the coupon rate, and the maturity, I can calculate exactly how much I will receive.
Very nice. Thank you very much. What role do interest rates and maturities play in bonds?
It is a crucial factor in determining what kind of deal I am entering into as an investor. The point here is, in my mind, I am the bank. I benefit when I receive interest over a longer period of time. That's what I want to do when interest rates are high. But if interest rates are low, then I definitely want to go for shorter maturities because I'm not getting high interest. If the interest rate level changes during the term, then this also has an impact on the price of the bond. Bonds are traded on the market, and this means that bonds react to changes in the interest rate level. Let me provide you with a concrete example. If you had indeed purchased a 30-year US government bond in August of 2020 and subsequently sold it today, you would have unfortunately experienced a significant loss of 40% of your initial investment. The value of this particular bond dramatically dropped from its original price of 100 down to a mere 60. Is that because people believe the US government is going bankrupt? No, definitely not. The reason is that at the time in 2020, the bond had an interest rate of 1.2%. Today, it's almost 5%. That means that today, when the US government issues new debt securities, it has to pay 5% interest. But this means that the bond that has already been issued also has to rise to the same interest rate level. However, the coupon is fixed, and this adjustment happens on the market through the price of the bond. In this respect, someone who bought long-term bonds from the US in 2020, and it's the same in Germany, has lost about 40% of their money if they were to sell today. Interestingly, banks that also held bonds don't have to write them down in their balance sheets. It's a completely absurd situation. They can simply record them at the same price they bought them for. The principle of commercial prudence does not apply here. This way, the state is able to offload more bonds. But the point is, as a private investor, as an investor, I really have to think carefully about how maturities are changing, how interest rates are changing, and which maturity I should choose accordingly.
So, do you typically tend to go for long-term, short-term, or perhaps even medium-term bonds? Because I genuinely think there's a really significant market for short-term bonds, that many people truly like to purchase short-term bonds, whereas they are often not as strongly motivated to acquire long-term bonds.
Yes, the right answer here is it depends. The point is, you have to assess that short-term bonds short-term, I mean bonds with maturities of 3 to 5 years, so short to medium-term have the advantage that the interest rate risk is practically eliminated. Because if I hold on until maturity, I get my money back. The fact that the interest rate level has changed in the meantime doesn't matter. Because if I bought the bond at the issue price of 100 and I get it back at 100 at maturity, and I've received my interest payments, then it really doesn't matter whether the interest rate level has changed. But in certain situations, it can also be quite attractive to lock in the interest rate level for a longer period of time. Let me give you an example. At the end of the financial crisis, the market was very nervous, and accordingly, companies had to offer the market very high interest rates in order to issue bonds. And back then, there were 2 bonds that we also bought for clients. One was a bond from Daimler, which had a coupon rate of 9% and a maturity of 2 years. We thought, wow, this is really a good deal. They were also secured by tenor, and we bought the bond at that time. For 2 years, you received 9% and 9%. At the same time, there was a second bond that we also bought. That was from John Deere, the big tractor manufacturer. And they had a bond with a 10-year maturity and an 8.5% coupon. A little less, you might say. Okay, both deals were reasonably good, we thought. But the point was, after 2 years, they paid 2.5%, 8.5%. After 2 years, both companies were able to refinance at 1 to 2%. The worries from the financial crisis had faded. The market was open again. The Daimler bond had matured, and Daimler issued new bonds, this time with a 1 to 2% coupon. John Deere did the same, issuing bonds with a 1 to 2% coupon. But this bond was still on the market and couldn't be redeemed early, and its price was at 160. And accordingly, it was a very important learning experience for us. In the end, we made a major mistake and gave in to the temptation to buy Daimler at 9% for 2 years. The right move would have been to focus much more on the John Deere bonds that were available at the time and to lock in the interest rates for a longer period, because someone who invested in the Daimler bond received 18%. Someone who invested in the John Deere bond received 17% plus a 60% price gain. Accordingly, when interest rates are high, you have to lock in those rates for the long term. It's very important to keep this mechanism in mind.
Very nice. So, if you're interested in bonds, and want to know more about them, and if you're considering adding bonds to your portfolio as a diversification, then give us a call. I would be happy to arrange a meeting with Helge Müller for you, and we can take a look at your portfolio together to see how we can incorporate bonds. This can be especially interesting for older generations, for people who live abroad and receive pensions, that is, those who rely on regular payouts. With bonds, it's not like with stocks. With bonds, you already know in advance what you're going to get. The only thing is, you have to choose the right issuer. And that's where Helge is, of course, the top guy, because he actually goes into the companies. He visits the issuers face to face, goes into the company, looks at the balance sheets, talks to the key people, and selects issuers where no mistakes are made. That's why I have also invested part of my private assets with Genève Invest. That's the name of Helge Müller's company. And I have to say, I am very satisfied with it. Thank you very much. Goodbye for now, and thank you for watching on our YouTube channel.